But let's welcome on board Anand Shah, CIO, PMS and AIF at ICICI Prudential AMC, and chat about what he's making of the market and the investor sentiment right now. Anand, hi, morning. Great to have you on the show as always. Anand, while all the macro data points and the parameters now seem to be looking up, a big beat on earnings as well at large. But I guess this kind of fresh paper, so many blocks, QIPs and IPOs, that's going to keep the market a little under check.
Indeed, I think that's been the story for a while. We have continuous supply of paper, but it's been compensated by a very strong domestic flows, be it in mutual fund or otherwise. So yeah, that's been the story, and that's also keeping market reasonably priced. So I think two things. One, ideally, such an FI selling would have made Indian market very underpriced, and such an extent of domestic buying would have made market overpriced. But fortunately for us, this is more balanced, and to that extent, it's been continuing for a while, where domestics are continuously buying in FIs, and the private equity supply is continuously being absorbed in the market.
Okay. Anand, but just in terms of earnings momentum, right? Hi, this is Harsha. So just in terms of earnings momentum, right? We've seen a decent momentum build up in Q1. Do you expect we just get better from here? Because we've had a couple of tough years in terms of earnings growth. Does it get better, especially at the large cap end of things?
Indeed, I think, look, as long this rupee depreciation is one of them, and the inflation, I think both are, in general, if you ask me, we perceive that as a negative. But if I were to add both the things together, it's negative for consumer, but it's actually positive for manufacturing. And to that extent, if you see even the underlying trends in the earnings, there are two spectrums. There is the manufacturing, which is globally competitive. It's either substituting imports or doing more exports. We are seeing a nice tailwind of earnings there. At the same time, high inflation, depreciating rupee is also negative for consumption, and to that extent, there is a challenge as far as consumption growth is concerned. Obviously, the GST rate cuts last year have helped auto and have helped many other segments of the market. So yes, there is a support from RBI and government for consumption, but otherwise, when you look at macro, which is the combination of a high inflation and depreciating rupee, is actually positive for manufacturing and negative for consumers. And that's reflecting in the earnings split that we are seeing.
That it sure is. So, I mean, structurally, Anand, what are the big themes that one should be betting on right now? Timing it, of course, is anyone's guess, and that opportunity will come in whenever it does. But just structural stories that you would want to stay put in for the long haul.
I think one structural change that has happened generally in the world economy, but more so for the Indian economy, has been transition from globalized world where China would manufacture everything for the rest of the world to a world where people want to manufacture closer to the borders or in the friendly economies. And to that extent, even there is a big wave of capex happening in US as we speak, because US is onshoring a lot of manufacturing. Coming to India, India is also doing the same thing. I think the big structural change is less of globalization, more geopolitics risk versus what we had in the last 2 decades, and of course tariffs. And combination of all that means that the manufacturing capex, which has been sort of improving, but not to the extent one would like, the private sector capex, I think that should sort of get a fillip. And especially the rupee depreciation is the last bit that significantly improves the manufacturing competitiveness of the Indian businesses, be it for import substitution or for exports. So combination of many things coming together, our large overweight in the portfolios have been towards manufacturing, towards capital goods, towards more supporting industries for manufacturing, and we've been sort of underweight consumption.
And Anand, within manufacturing, I wonder how you're looking at this entire EMS space, right? Because if you're bullish there, how much do you believe of the valuations have actually run up, and how much of the future earnings have already been priced in? If you have a view there, or it's just so structural and it's so decadal that you typically don't mind the price which you're paying for stocks like these. How should one look at that pocket?
Indeed, I think that's been the big difference from 4 years back till date. A lot of recovery in manufacturing has happened. The balance sheets have improved. Uh, the, the the earnings have gone up significantly, and more importantly, the PE multiples means the investors have also sort of warmed up to that sector. So it's not as undiscovered as it was in 2021, 2022. So you're right. I think we have learned our lessons in 2020, 2021, or prior to that. People used to say the consumption stories, valuations don't matter, and then we have paid the price for that as a market. We have seen how many consumption stories, which are supposed to be the bluest of the blue chip, have not delivered any stock market returns, any investor returns for last 4 years. If we make the same mistake where we say that, look, it's such a decadal story that you can buy any manufacturing sector at any price, would be wrong. And to that extent, understanding business prospects and more importantly, valuations becomes that much more important when the valuations are what they are in the EMS space.
Anand, just to the point that you were making earlier about manufacturing domestically and looking inward, aren't all those themes well discovered and now sitting at high valuations?
And yes, to some extent, you're right. And that's what I was saying, that in last 4 years, we have seen quite a lot of outperformance of manufacturing sector and underperformance of the consumption sector. But what the West Asia war does further is, and the rupee depreciation along with that it does, is it gives another leg up to the manufacturing sector. We've been looking at the entire breadth of the manufacturing sector, from as old economy as textiles and metals to as new economy as semiconductor manufacturing, solar cells manufacturing, and so on and so forth. So I think the entire gamut of manufacturing, including, we are launching now rockets from private sector. So I think the entire gamut of manufacturing is worth exploring. We've been researching anything and everything under the sky. There are sectors which are well known, like chemicals, auto ancillaries, which are the success stories already. We are globally competitive there, and there will be many more which will come through. So yeah, there is a merit in doing bottom-up research and identifying right sectors and right businesses to invest in manufacturing.
Anand, last off, difficult to let you go without having your view. Private sector banks, it's a pocket which is, a consensus buy trade. Do you believe it can outperform next 12 months? And also IT, I wonder what your view there is.
So both the sectors we've been, now sort of coming into a value zone. Definitely, private sector banks have pristine asset quality. They have significant moat in form of access to the low cost of funds. And to that extent, the earnings, the return on equity, those are not the issues at this point of time today. More importantly, the private sector has got deleverage. So the asset quality, as we try to see forward, also looks benign. And to that extent, the earnings growth seems to be reasonable for the price at which you're in. So in that sense, yes, both private and public sector banks, overall the banking sector looks in the value zone for us. And to that extent, we have some exposure there. IT is something we've sort of changed our views more recently. We've been underweight, or for that matter, we didn't own IT sector for a while, given the valuations were too high for the risks that were there, especially on the growth. Now, those risks to the growth have in a way played out. The deflation out of AI is also in a way partly into the numbers already, maybe some more to go, and the valuations have come off. So to that extent, we are more bottom up. We are looking at businesses where there's room to grow against the headwind of AI and still deliver returns for the investor So we've been sort of turning a little positive on IT at this point of time.
Understood. Okay, Anand, great to get in all the insight from you. Thank you so much for your time today.
My pleasure.